What's up, everybody? Welcome back. Thank you so much for joining me today. Today is going to be a little bit of a different video. We're not going to be looking over charts, but what we are going to be talking about is the Greeks. What are the Greeks when it comes to options? What do they represent? What are some easy ways to think about them? We'll get into some more in-depth videos in the future on each one of these specifically, but we're just going to do a quick overview today, and hopefully this is going to give you a better understanding of what to look for and what they represent, and maybe how to use those and think about those. And let's go ahead and get started. So options Greeks are the mathematical measure that describe the sensitivity of an options price to various factors. Each Greek measures the impact of changes in market conditions on the price of an option, providing traders with critical insight into the potential risks and rewards associated with their options strategies. Here's a basic introduction to each of the primary options of the Greeks: delta, gamma, theta, vega, and rho. Let's talk about delta. Delta represents the rate of change in an options price with respect to $1 change in the price of the underlying asset. For call options, deltas range from 0 to 1, indicating that the options price is expected to move in the same direction as the underlying asset. For put options, deltas range from -1 to 0, suggesting that the options price will move inversely, or opposite to the underlying asset. A higher absolute value of delta implies the greater sensitivity to the underlying asset's price movement. Let's talk about gamma. Gamma measures the rate of change in delta with respect to a $1 change in the underlying asset price. It shows how quickly an option's delta changes as the price of the underlying asset moves, indicating the stability of an option's delta. A high gamma means that delta is highly sensitive to the movement in the underlying asset's price, which can significantly affect the option's price. Let's talk about theta. Theta quantifies the rate of change in an option's price with respect to time, specifically the time decay as the option approaches expiration. It is usually a negative number, indicating that the option's value decreases as time passes. Theta helps traders understand how much value an option might lose each day as it nears its expiration date, assuming all other factors would remain constant. Let's talk about vega. Vega measures the sensitivity of an option's price to changes in the volatility of the underlying asset. It indicates how much an option's price could change with a 1% change in the asset's implied volatility. Vega is particularly important in options trading, as volatility can significantly impact an option's price. A higher vega means the option's price is more sensitive to changes in volatility. Next up, we have rho. Rho represents the rate of change in an option's price with respect to a 1% change in interest rates. It shows how much the price of an option is expected to change when there is a change in the risk-free interest rates. Rho is more relative for long-term options, as interest rates can have a more pronounced effect on the cost of carry over longer periods. For call options, rho is usually positive, indicating that their value increases as interest rates rise. For put options, rho is typically negative as the value decreases with rising interest rates. Understanding the Greeks allows traders to better manage the risk associated with options trading, tailoring their strategies to maximize profits or minimize losses based on expected changes in the market. Each Greek provides a unique perspective on how different factors can influence an option's price, enabling more informed trading decisions. So let's imagine you're at an amusement park with a lot of fun rides. You have a special ticket that lets you ride any attraction you want. The Greeks in options tradings are like the different ways you can measure how much fun you might have on those rides. Delta is like how much fun you'll have on a ride if it goes a little bit faster or slower. A ride is really fun when it goes fast, then it has a high delta. Gamma is like how quickly your fun changes as the ride's speed changes. If your fun increases a lot when the ride speeds up just a little bit, then it has a high gamma. Vega is like how much fun changes when the park gets busier or quieter. If you have more fun when the park is less crowded, then your ticket has a high Vega. Theta is like how your fun changes as the day goes on. If you have less fun on the rides as you get tired, your ticket has a high theta. Rho is like how your fun changes if the park changes the price of the tickets that you bought. If you have more fun when the tickets are cheaper, your ticket has a high rho. The Greeks helped people who trade options understand how the value of their special tickets, called options, might change based on the different factors like the speed of rides, the number of people in the park, or the time of day that's left. Let's be clear, options are a form of a derivative. So what's a derivative, you might ask? Derivatives are contracts whose value derives from the value of an underlying asset, such as a stock, a commodity, or a currency. Options, on the other hand, give the holder the right but not the obligation to buy or sell that underlying asset at a specific price by a certain date. Financial derivatives are kind of like trading cards. Just like how you can trade different cards with your friends, financial derivatives are agreements to trade something else, like money or assets, based on how something else, like the weather or the price of something, changes over time. For example, imagine you and your friends make a bet about the weather tomorrow. If it's sunny, your friend will give you $2, but if it rains, you'll give your friend $1. That's a simple financial derivative. You're making an agreement to trade money based on something else that's changing, like the weather. Of course, financial derivatives can be a lot more complicated than that, but the basic idea is really just the same. It's a way for people to make agreements to trade things based on how something else changes over time. All right, everybody, that wraps everything up for today. I hope you learned at least a little something about the Greeks, and remember, we'll go into more depth in future videos on each one of these. Appreciate you watching. Thanks, and see you again.